Hey, good morning, everybody, and welcome to this May 17th edition to Coffee with Great Wealth Strategies. Here's my cup of Joe. I'm hopefully filling your cup up and ask you if you'd please pass this around YouTube and other places so you can fill other people's cups up. This is Eric Kenyon, also known as Regular Joe, and we're going to jump into quantitative easing. We're going to talk a little bit about the Federal Reserve and how it is potentially beginning to wind down their quantitative easing QE3 and their 85 billion. So let's take a look at this. This comes from a very good source on Wall Street, and I'm going to go through the data here and see what kind of repercussions we'll have. But a gentleman named John Hilsenrath of Wall Street Journal has a reputation for reporting on the inner workings of the U.S. Federal Reserve, with suspected guidance from officials within the American Central Bank itself. Regardless of his sources, though, as we've examined in the past posts on this blog, the latest missive from Hilsenrath shined a light on the latest Fed manipulations, which relate to the eventual wind down of its extensive monetary stimulus program. According to a May 11th publication in the journal, the Fed is actively seeking a comprehensive plan for reducing the current iteration of quantitative easing, which we're going through right now, which represents an account of about 85 billion in bond purchases each month. Now here's what's important here, guys. Listen to this. Hilsenrath stressed that Chairman Ben Bernanke and his lieutenants are being extremely cautious about the prospect of triggering a broad market sell-off, considering that the Fed's generous liquidity offerings each week are suspected of what's keeping the prices at artificially elevated levels. Investors, therefore, should expect to see slow, step-by-step process, but if the general public and Wall Street starts to pick up to this, we could see a massive broad sell-off in the market, as I reported back in September last year. Recent statements from regional Fed presidents, including Richard Fisher of Dallas, indicate that the central bank will not simply pull the plug. In an interview, Fisher noted that the Fed ought to dial it back and bid to keep market participants from panicking. So they're going to do a bid to keep people from panicking, and it's selling off, as I just said. However, it remains to be seen how clean the monetary exit will actually be. Just be watching this, guys. Be careful. Interest rates will surely creep up, although the rate and intensity that these movements are tough to predict. They're very tough to predict. The possibility also exists that the Fed could slow or even rewind its stimulus reduction. Its officials suspect that the U.S. economy is beginning to teeter once more. And this was an article that was written on May 11th, and we're starting to have those concerns as we keep bringing up here that the economy is not as good as we think it is or what the media is telling it is. You got to look at those U6 numbers. You got to look at production. You got to look at some of this stuff. Anyways, these developments suggest that stock market could be in for a very bumpy ride over the next year, 18 months, 12 months, 6 months, potentially imperiling some people's sources of income. As such, we would very much so encourage you to come take a look at some solutions that we may have for you over at greatwealthstrategies.com. So please come check it out, and definitely share this information with friends and coworkers. Twitter this and get this out on Facebook, and subscribe to the channels. We do appreciate you, and thanks a lot. Bye-bye.